go through our slides.
We're going to be talking taxes today on Dollars and Cents, and we'll be right with you after this.
Worried about taxes? Who isn't, right? As our country continues to ponder how to pay for stimulus measures and relief efforts that were enacted during the pandemic, the Biden administration already has laid out several tax proposals that would leave the wealthy and corporations facing increases. While changes to tax legislation may be beyond our control, we can develop plans that include tax-efficient strategies, estate planning options, and much, much more. Protect what's yours. Call the Resource Center today to see how we can help minimize your tax bill to Uncle Sam.
And thanks for joining us once again here on Dollars and Cents with your financial expert, Bruce Porter. And we're talking tax. We talked about taxes last week.
Yeah, I think it's something we need to continue. I mean, this is the time of year everybody should be thinking about their tax implications for their earnings this year, right?
Yeah, absolutely.
And if you're retired, if I could show you ways to mitigate future tax liability, that would be a topic of interest for a lot of folks.
We would be very interested in hearing what you had to say about that.
And so today we're going to dive into this tsunami coming in 2026. Go back one.
Well, I think that's
There you go.
There we go. Sorry.
All right. Little hiccup.
Yeah.
2026 tax increase coming up here in 4 more tax periods because we're still in 2022. So there is time to still act and take advantage of this year. But then you got 3 more years, 23, 24, and 25, and then the Tax Cuts and Jobs Act is going to sunset.
Otherwise known as the Trump tax package.
That's right.
Yeah, okay.
There's 23 provisions that will be expiring at the end of 2025 that's going to directly affect tax brackets. From what I've seen, they're going to lower the amount of income you can make and raise the percentage of tax. So it's a double whammy. You make less money, you pay more tax. And so because of the adjustments in the provision. Now, the standard deduction that we've all become accustomed to, seniors, it's above, married filing jointly is above $25,000.
Yeah.
And for single people, standard deduction is right at $12,000 and change. And so that's going to be one of the sunsetting provisions.
That's going away.
Who knows what's going to happen as far as how they're going to adjust.
Well, and
but
that
it's
hurts
not going to be in our favor.
And that hurts the poor, and it hurts the seniors on fixed income.
Yeah, I mean,
most.
Don't kid yourself. From the estimates that I've seen, and I was in a 3-day tax meeting, and boy, you don't ever want to do that.
Congratulations.
But I was in a 3-day meeting and about the tsunami coming. And I don't care what the politicians say, be prepared because the middle class is going to get hammered and it's not going to be pretty. Now, what effect is that going to have on IRA money? That's a really big question because there's trillions of dollars in IRA money. Whether you're working with your 401k, 403b, 457, whatever qualified plan you have through your employer, when you roll out of that, those funds become IRAs. So you avoid current tax and you can defer until 72, et cetera. So now, qualified distributions out of IRAs could be taxed, could
right.
be taxed. We have to be compliant friendly when we talk about these changes that are coming up because nobody knows for sure.
Yeah, crystal ball's in the shop today.
That's right.
Yep.
So could be taxed at a higher rate. I would lean towards the higher end. RMD withdrawals, for example.
Required minimum distributions.
That's right.
Yep.
At 72, you are forced to start taking a percentage of your IRA balance out of your plan. So now, now it's a very modest amount. It's, I believe it starts out at 3.65 of the balance in the IRA on December 31st of the previous year. So that's how they calculate it. The only amount in your IRA that matters for the qualification or for the requirement of distribution is the balance of the IRA on December 31st. The day before doesn't matter. The day after doesn't matter. So if you're in a variable IRA and the market peaks, your RMD is going to be based on that peaked value, even if it drops like a rock the next day.
And that could wipe you out.
And it could hurt.
Yeah.
So, but effectively it starts out at 365, 3.65%, goes up a little bit every year, give or take around 5% at age 80, 5 somewhere in that bracket. So it just increases a little bit every year. So the idea behind IRA planning is to create longevity. It's to create sustainability of value. And so when we're looking at long-term planning with an unknown tax, we're planning out in blue sky.
Well, what this means to me, what I'm hearing is I might want to, in the next year or two, take more than my required minimum distribution because as I'm looking at it, it seems to me like if those sunset provisions go away, I'm going to be paying more in taxes. Tax rates are going to go up.
That's great. That's a great point. So let's go to the next screen.
Oh, uh-oh.
So,
did I get ahead?
Nope, you didn't. So now let's consider a Roth alternative. So just exactly what you said. A lot of people think, I'll just start taking more out before that. Okay, so we got 3 years. So you have to take 30% of your IRA this year. Well, if you did it this year, 25, 25, 25, 25.
Yeah, a quarter, or a third.
Now, what's that going to do to the income you have, your Social Security, pensions, anything you have? You're going to be in a higher tax bracket right now. Now, the effect of that, if you take it and spend it, is you're going to get hammered.
That's bad.
Right?
Yeah.
Now, what are you going to do with that money? Throw it in the bank at 3 or 4%? Well, I mean, inflation's 18 or 20. So, I mean, there's you got to put a little bit more thought into that. There's not a lot of sense to that unless you need to spend that.
Can I just get you to do my thinking for me?
Well, you could retire debt, right?
I could.
I couldn't disagree with that, but it's a very expensive way to retire debt.
That's true.
So now a better alternative might be to consider a Roth alternative. So now, if you can, everybody pay attention, if you can pay less tax today than you will tomorrow, would you rather pay tax today or wait till tomorrow?
Wait, say that again?
If you could pay less tax today versus more tax tomorrow,
yes,
would you rather pay it today or wait till tomorrow?
I think I'd rather pay it today.
So, exactly.
Okay.
So if I've got $1 million, let's exaggerate, and I took all of my IRA out, you're going to have a lot of tax.
All right. What, 300 grand?
Well, let's estimate that.
Okay.
I mean, that'd be 30%. That's probably up there, but let's assume that.
Okay.
All right. And so, say you're going to lose a third of that to the IRS today.
Right. Yeah.
All right. That'd be great. What if tomorrow that same tax on that same full distribution is $400,000?
Yeah.
By doing it today, you could save $100 grand, right? That's just simple.
Well, I think the hard part for somebody like me to understand is that I'm going to pay that tax someday. It's going to get paid. So I almost have to think about that as right now, that's already out of my account.
Right. It was never yours.
It was never mine. It's never going to be mine. It just looks like it's mine.
Now, let's say that you did that and you did not need the money right now. And let's say you're 62 and you're retired early, but you don't really need the income, right?
Right.
You're going to defer it until you have to take it, the RMD at 72. So you got 10 more years. Well, I would rather pay my tax now, pay less, than to wait into the future and pay a lot more. And I can defer that in a Roth, and now it's going to hopefully grow back, right?
Yeah. Tax free.
So let's speculate,
Okay,
right?
sure. We're
So
just
now,
guessing.
Now I've got my $1 million back when I'm 72, 73, 75, somewhere in there, and it's all tax free.
Oh, yeah, because you made it back tax free.
Because it's all in my Roth IRA.
Well, that's
so,
awesome.
Now, the answer is not to do all or none. The answer is to develop some type of a plan that suits your family. Whether you do 10% per year converted to an IRA or a Roth,
yeah.
or if you say, you know what, I want to do a lot, and I want to make sure by 2026 I've got all of my IRA converted to a Roth. Well, you take advantage of 22, 3, 4, and 5. You do 25% of your balance every year, and what you're doing is you are basically spreading out your tax liability, getting it all taken care of at less tax rate than you will after 2026. And so you spread that burden out. Now, there's not 3 years to worry about it. People procrastinate about this.
Yep.
And I've said in other shows that I've done around the world, right?
Right, yeah, worldwide.
Right.
Right, we're reaching the world from right here.
Don't be a passive investor.
Absolutely,
right now
yeah.
is not the time to rely on your broker or your banker or your tax person or anybody else to tell you what. It's time to dig in, do some work, get with somebody like us that you can just sit down and talk to and figure it out.
Yeah.
And figure out what's your best strategy over the next 3 or 4
Well,
years.
I'll tell you what I'm going to do. I'm going to call 417-882-1800, and I'm going to set an appointment. I'm going to come and see you.
Hey, I think that'd be good because now we've been discussing the fair tax.
Yes.
And repealing the 16th Amendment.
Mm-hmm.
And you know what? It's because of things like this that the government does, not in secrecy. They'll be glad to tell you they're going to charge you more, but they don't tell us until the time.
Yep.
And it's coming in our world, financial world.
Yeah.
We've seen the estimates, and no one really realizes
Yeah.
what's going to happen in 2026 when the new tax codes come out.
Yep.
And I think we need to be doing something about that. And hey, let us know if you support a fair tax type thing.
That's
if
right.
you don't know what that is, and that's pretty much for Missouri.
Missouri and for the nation.
That's
yeah,
right.
It's for both.
And so eat that elephant one thing at a time,
That's right.
one hoof at a time. So now, for Missouri, the fair tax makes it fair for everyone.
Fair for everybody.
And based on consumption. And I think that people need to dive into the details of that. Call us and ask us. We'll be glad to give you some highlights of that.
Yeah, or you can check that out at fairtax.org, and
Yeah.
you can find out more information about the fair tax. But if they
right.
need to see you, it's resourcecenterinc.com or call him at 417-882-1800.
Yep.
Thanks for joining us, Bruce.
Christmas is coming.
Christmas is coming. There's the number, and we'll see you next week. Thanks.
Investment advisory services offered only by duly registered individuals through AE Wealth Management, LLC. AE Wealth Management and the Resource Center, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet a particular need of an individual situation. The Resource Center, Inc. is not permitted to offer, and no statement made during this podcast shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by the Resource Center, Inc. This podcast is a paid placement.